When I look at those people that I've worked with that really are the most successful from a business perspective entrepreneurs, places where they have an emotional or a financial sunk cost.
So a strategic expense is something that you put money into that has a lasting, repeatable revenue impact on the business.
Maui Mastermind presents the Business Coach Podcast, answering your questions and providing real actionable insights for building a better, stronger, more profitable business without sacrificing your time, life, or freedom anymore.
Hi, welcome to another episode of The Business Coach. I'm your host, David Finkel. In today's episode, I'm going to be talking with Maui Mastermind business coach, Rich Wood. Rich and I, who has been a guest and a co-host on many of these episodes, are going to dive deep into looking at your company through the lens of profitability. How can we find places to dramatically increase profitability? So many business owners get stuck in old ways of doing things that are lower margin, less profitable, that if we can look at things fresh, we can get rid of the sunk costs, the emotional ties that distort how we see the business, we can find opportunities to increase profitability, and in many cases, fast. So welcome to another episode of The Business Coach. And with that said, I want to get started here, and let's jump into the episode. Well, Rich, welcome to the podcast. How are you doing today?
Thanks, Dave, for having me. I'm doing phenomenal. I'm doing very well. Thank you.
Oh, I'm so glad. All right. So today we get a chance in this episode to talk about looking at a business through a profit lens. I mean, you and I as business coaches have worked with lots and lots of companies.
Right.
And sometimes they get mired, especially the owner of a business. You'd think that she or he would be fully incentivized, that they would be looking at the business from the perspective of profitability. But I think we both have seen cases where a business owner gets locked into seeing their company distorted. And because of that, they miss out on opportunities to free up wasted resources and reinvest them for better, higher uses, or they invest them in places in the business that don't make the most sense. So I want to start today by talking about this idea of looking at the business from a profit lens. And let's start with this question. What have we seen working with clients that we coach that causes them to look at their business differently than that, to look at their business from a comfort standpoint or what they know standpoint or what they've got invested already in terms of sunk costs for different initiatives or projects or people versus truly from looking at it from a fresh profit perspective? I'm curious what that sparks for you.
Well, so it's interesting that you asked that question, and that I'm going to go back to over the last 15 or 20 years of coaching businesses and coaching business owners. In over the time frame that I've been working with businesses and the leaders, I've really seen a couple of things. Number one, I think people oftentimes think that if they have money in the checking account for the business, that they're profitable, right? Or that they're making money. That's number one that I've seen a lot of business owners do. The second thing is that I see a lot of business owners focusing on what their net operating income might look like, and think that if they're generating 5, 6, 7, 10% net operating income, that they're a profitable business. Well, the other thing that I see a lot of companies doing is that they don't really understand what the components are, what the simple things are that business owners can do to drive more profitability out of the business. And there's a couple of things that we could talk about that I would love the audience to learn about. And there's some simple things that you can do to drive more profitability out of the company.
Let's come back and we'll get into gross profit margins, operating profit margins, labor efficiency ratios, and that part in a moment. But something you said here just really struck me was, hey, Rich, if I've got money in my checking account, that must mean I'm profitable. But we both know, one of the things you and I have learned is the difference between accrual accounting and cash accounting.
Right.
Talk how that might distort someone who says, Rich, I've got money in my bank account, forgetting the fact that it might be loan proceeds or balance sheet deposits or something like that. Give me a quick description of what's the difference between accrual versus cash accounting, and how might that money in my checking account really not be profit?
So the biggest difference to me in between accrual and cash accounting is when do you record the receipts of the income and when do you record the expenses, right? So in an accrual basis, you're recording as you invoice and you're balancing the accounts payable as you invoice product. Whereas on a cash basis, you're recording the cash received when somebody writes you a check or when you get the cash in the bank and when you actually deliver a product. So a lot of people really don't understand the nuances between accrual and cash accounting and when you might want to use one approach versus another.
Yeah. And just a quick tip there, whenever I'm looking at someone's financials, I'll oftentimes line up cash versus accrual right next to each other on a P&L and a balance sheet. And it's interesting what you see. Well, sometimes you'll see things that they're exactly the same, which tells me in some types of businesses that the financials must be off. You know, if I've got a business with lots of inventory and the cash numbers are exactly the same as the accrual numbers, that's a quick canary in the coal mine saying that whoever set up the chart of accounts and whoever set up and is doing the bookkeeping is wrong, because they can't be. Inventory would be booked differently on accrual. All the inventory shows up on the balance sheet. None of it shows up in the P&L until it's either been sold, written off as obsolete or broken, or some other way that it converts it from balance sheet to the other. But I'll come back to something else you said. You were talking here about components of profit. Let's come back to that in just a moment. But first, I want to even step bigger picture. When I look at those people that I've worked with that really are the most successful from a business perspective entrepreneurs, they have a real ability to look at things and be willing to cut places where they have an emotional or a financial sunk cost, a type of product line that really they discover they shouldn't be selling, or a customer segment that really they shouldn't do. And I'll give an example that I'm curious what this sparks for you, Rich. So today I was talking with one of our coaching clients, and they're an IT services company, and they tend to work with more complicated engineering types of clients. However, even in their world, the owner made a distinction between what he calls really complicated to scope projects or engagements is what they'll call it, where he'll say that they have an issue, probably at least in the six figures, on direct labor costs that they waste because some of the projects they do for some of their clients are complicated or so complicated. Oftentimes they don't introduce all the elements. And so what happens is they do the engagement, their scope creep, they end up paying for things to be delivered that weren't in the original scope. And as a result, he was saying that he thinks probably that costs them at least $100,000 or $200,000 a year of labor cost. And my comment was, well, that's great. If that's labor cost, what that means is that means you're probably missing out on somewhere between $500,000 and $1 million of revenue, because the labor cost is just your hard cost of the people doing it. You're, based on your profit margin, it's probably a 5x markup on labor, not to mention the opportunity cost, because if you had focused on better projects, you're now missing them because more complicated projects take more of your better people, which is kind of funky, right? Sometimes we have a business owner who takes a project type that takes more of his or her best people, but has a lower margin than doing the cookie cutter stuff that they could do or their staff could do in their sleep. Might not be as exciting. So it goes back to, well, why do people do it? Well, because the owner either finds it exciting, or the owner remembers the days back when they were scrambling for enough to survive and they would take any type of reasonably okay business versus being picky about where to use their resources. This is an example where if that owner had been willing to say no, or if he does do the complicated stuff, not to bill it through like his normal production stuff, but to bill it at a 2 or 3x markup to make it more profitable or worthwhile, that makes sense. But it's hard because he's got all this invested emotional energy in these types of projects. I'm curious what the sparks for you, because I know you must have seen this with clients you've coached.
Well, so it sparks a lot of different thoughts. So the first thing that I'm thinking about as you're describing that is scope creep, right? That's a big problem for a lot of different businesses because they don't clearly define what the scope of the contract is or what the scope of the services are that they're providing. And because they don't clearly define it and contractually obligate themselves in an agreement that they put in place, then there's obviously going to be scope creep. And oftentimes the implementers of the job services that are being provided don't think about staying within scope. And that's where extra labor hours get spent that erode a fixed budget, right? Or extra hours get spent that don't get charged to the client. So scope creep can be a killer to a business. The other thing that can be a killer to a business is if they don't have contractual agreements in place that define scope, define schedule, and define product deliverables, that's also a place where companies, service companies or product-oriented companies bleed cash, right? So if they don't have contractual obligations with their clients with timelines and metrics that they're measuring on an ongoing basis, that can create problems. So both of those things are areas that can erode profitability. The concept of emotionally driven business owners to do those things, to me, what comes to mind is if you can develop a cookie cutter business that's just repeat over and over and over again, that becomes a cash cow for a business that drives profitability way up, can drive revenue way up, and simplifies the business in many different areas. So I think the concept of simplifying the business as best you can through cookie cutter, repeat business model oriented business is the way to go.
Two quick stories on that, Rich, and I'm curious what this sparks you. So we've got one of our joint clients, construction company. They grew up in an age where early on in the first probably 5 or 10 years in business, that majority of the revenue came from projects that were really fancy addition types of projects that would be $150,000, $200,000, $250,000 project engagements. Over time, they've developed another area of their business that tends to do things in about the $30,000 to $60,000-ish range. What's interesting is that their margins on a $222,000 job are actually a lot lower than their margins when they do these cookie cutter, $50,000 projects. These $50,000 projects, they can make 2-3 times as much for the job per unit of production day on their schedule because they've gotten so good at it. And it kind of brings back to a different contractor that we work with that does electrical work. Well, he took great pride, Rich, in telling me, really nice man, very good at what he does in his early 60s. He takes great pride that he's the guy who can do these electrical projects in the commercial space, these
Right.
$200,000, $300,000, $400,000 jobs that in his area, no one else knows how to do. And then I asked him, I said, well, okay, well, let's just ask the question. You do these complicated jobs that no one else can do. How do you price them? Well, I price them just like I always price them, profitable. I said, okay, let's look at that. When you put a price in for this type of job versus something that's really easy for you to do that doesn't require the same level of expertise, are they at about the same types of gross profit margin? His comment to me was, yeah. And I said, well, that tells me you're not doing it right. I brought up the distinction between a production model versus a custom model. A production model being, if it's something I can do again and again and again, and what drives the profitability for a production service model is efficiencies of doing similar types of projects again and again and again, versus a custom model says, I'm getting paid for really refined expertise that they can't find somewhere else. If my gross profit margin is the same on both, it's broken, because my gross profit margin for a custom model should be many times more, because I should be charging for the expertise, not just for the hour of labor with that part. And so I went back to him and I said, look, if you're going to do this custom work, good, but you can't charge $150,000 for the project. You're going to have to charge $300,000 for the project or $400,000. He said, well, hang on, no one's going to pay me. I said, well, hang on a second here. They need the work done. You're the only one that can do that. You should get paid for the expertise, and that should be built into your pricing. If they really could easily get someone else to do it, then that's a production job because it's not an expert job.
Right.
And we went back and forth on it. He finally got it. He still struggles with it. It goes back to he's emotionally fearful. So, I think what gets people into trouble on the sunk cost part or don't rock the boat part is they're afraid of change because the change might be screwing up something that's working, or they change something that is working, the production part, because they get bored with it and think this other might be new and exciting. I'm curious what that sparks for you, Rich.
Well, there's a couple of things that you mentioned that I want to just elaborate on just a bit. So you mentioned pricing, right? In my experience, most business owners get pricing wrong, right? They get it wrong because they overcomplicate it or they undersimplify it. And I think that pricing is one of those areas where you need to do a bottoms-up pricing to know what it's going to cost for you to make a certain amount of net operating income out of a job. So you should bottoms up price it so you know what the labor costs are, what all the components of costs are that go into it. And then you append a fixed net income number that you want, or a net operating income number that you want to make at the bottom line. And then you go back and you take that number as a baseline. This is what I need to charge to make money. And an important piece of that is know what your operating overhead component is, because a lot of people get that wrong, right? They don't even look at the cost of running the business. They just look at how they mark it up by 2x or 3x, and they think they're going to make money. So that's one big area where I see a lot of people, a lot of business owners make a mistake. So take the bottoms up pricing and then do market research to find out what your competitors are charging, and then balance what you think you can mark up or price a product or a service that's competitive, that gets you the margin you're looking for. So I think that's an area where a lot of business owners have problems. The other thing that's interesting is that if you look at cookie cutter business versus sophisticated, custom-oriented products or services that you provide, it's not just the service or product. You're dealing and selling into a different customer set, right? And the sophistication of the customer changes the more unique the products are, or the more complex your services are. The customer sophistication increases. And with that customer sophistication, the amount of energy it takes for you to manage a project, to stay within scope, or to sell a product that's complex becomes that much more challenging. Whereas if you stick to the cookie cutter stuff, you're dealing with a different mentality of buyers. So I think that's also something that I think people need to.
Hearing you say that was really interesting. So as we talk about pricing, one method of pricing is bottom up. Hey,
Right.
what do I want my ultimate operating profit to be? And now what do I need to back in to cover overhead, to cover cost of goods sold? What do I need to price at to be profitable? Bottom up.
Right.
The other way, Yukon talked about top down, where I'm looking at competitive analysis. What are alternative competitors charging for a product or service? And somewhere in relationship to that, sometimes I'm going to be in the middle, sometimes low, sometimes I'll be above there, but I have to be aware of that universe. And that's really important.
Yes.
In a production world where I'm selling something that other people sell, a truly apples to apples competitive product, or at least an Apple-ish competitive product. But you said when I sell to my custom folks, it's a new customer universe. And this is interesting,
Right.
because now no longer do I price based on competitors. I price based on two things: the cost of the problem that my product or service solves, and the difficulty or the scarcity of any other solution for it. And so the electrical side for this contractor is a great example. If I'm looking just to do, wiring and a simple build out for a large warehouse, my customer could go to any one of a dozen electrical contractors. If there's something really fancy about the electrical stuff that I'm doing, maybe, and I don't know enough to say about it, but with
Right.
tenants X, and there really is no viable competitor within my geographic footprint, what that now lets me say is, well, what's it cost my customer for not having a solution? Well, they might have a $12 million construction project that's being held up because they haven't solved X. So what's it costing them? It's costing them millions of dollars or hundreds of thousands of dollars of overrun. So I look at that, plus how hard would it be for them to find some other solution for this?
Right.
And now that's what I price in relationship. Really what we've done here, Rich, is we've introduced 3 different formulas of pricing depending on what I'm actually selling. Comment from you?
Yeah, I want to add one other layer of complexity, because nothing is as simple as we would like it to be. Unfortunately, and in the world of business, things are tough. So there's a timeline associated with capturing new business. So the more sophisticated your clientele are, or the demographics that you're selling into, the timeline to secure and to close a deal or to close a sale is much longer. And as the timeline increases, your cost to capture said business or client increases, and therefore your return on investment, because you're spending more money to capture a sophisticated, custom-oriented client, goes way up. Whereas if you focus on something that's simple, straightforward, it changes the whole demographic of how much money you're investing to capture a client or to sell a product than if it's a simple, straightforward cookie cutter, because the people are different, the timelines are different, and your ROI can be much higher with a very...
Makes perfect sense. So take the example, I have $1 million of sales overhead per year of salary for my salespeople. And that's just the base part, not the variable part from it. And that's including that. So now if my people, which is, let's say it's $100,000 a month, if it takes me 6 months to sell a job, I've got $600,000 of fixed sales overhead that I'm amortizing that project over. It better be an expensive project. If I can have that same $100,000 a monthly sales fixed overhead go toward 10 projects, each of those projects can be a lot less expensive, not just because of the margin of the actual project, but my sales cycle costs are a lot lower because I have more projects selling faster, so I don't have as much overhead per job sold under that model. And that's a really important point when we look at improving margins. That to any listener out there, any viewer, generally speaking, the faster you can accelerate your various cycles, the faster you can make your sales cycle, the faster you can make your repurchase cycle, the faster you can make your production cycle, the faster you can make your onboarding of a new client cycle. Any of these cycles, if you can go from X to half of X or a third of X or a quarter of X, you're going to proportionately be more profitable from a margins perspective. And the beauty is that those tend to be structural improvements to profit, which means it's not based on this one project one time, this one negotiation one time, but it is in fact something that you get the benefit of every time it goes through.
And there is one other layer to that I think is important as we talk about increasing the level of sophistication of a business. We talk about systematizing the business, operationalizing the business, and building that into the culture of the company. So the more standard approaches you're using, the easier it's going to be to systematize your business. And the more you systematize the business, the more repeatable your profits are going to be and the higher your margins are going to get.
I love it. We're going to move to another area here, Rich. So I was talking with a client yesterday, runs a $100 million plus practice where they do a medical business. And as I was talking with this key employee there, his comment was, we realized how much money we were spending on a particular type of medical supply. And in their surgery procedures, the costs were a lot. And his comment was, we now have 2 staff members whose job is on the wonky, unusual, quote unquote, higher customization types of surgeries, not their production surgeries that they use the same types of materials and or supplies again and again. So they already negotiate their discounts before. But for this unusual stuff, he says he now has a person who her job is to call and ask for discounts and effectively get them. He says on average, they save between $1,000 to $2,000 per surgery. They do over 50 cases or surgeries throughout their various facilities of this types of procedures. So that's $100,000-ish, $50,000 to $100,000 a month, $600,000 to over $1 million a year, wherein before they're getting the same stuff, but that drops straight to the bottom line. And that's an interesting one when we look at that. So this idea of looking at what you're spending, if I can buy the same for less, it automatically drops the difference to my bottom line, assuming I don't go spend it somewhere else.
So I have a couple of thoughts on that, right? So one of the things that I have learned the hard way and something that I encourage all my clients to do on an annual basis is to shop their supply chain, right? Which means you want to have multiple suppliers for the things that you're buying or purchasing on a regular basis. You want to make sure that you're getting volume discounts with the suppliers that you're working with. And you want to make sure that you're improving the quality of your supply chain as you develop and improve the size of your business, which gives you reduced risk, which leads to reduced risk in operating the business because you have multiple suppliers that have been vetted against a certain level of criteria that you use yourself to build your brand for your business. But the idea is that you can always ask for a reduction in the cost that you're spending to get a certain component of service or whatever. It doesn't matter if it's insurance or your legal support or whatever. If you let everybody know that you've got multiple suppliers and you're competing one against another for the best service and the best price, that goes along for cost of goods, but it also goes along for everything you do on the operational side, buying computers and accounting services, what have you. It always works.
I love it. So let's go through a couple kind of hardcore comments there. So I'm hearing from you, shopping your supply chain. You're improving the quality of your supply chain at the same time. You're asking for looking at if you've grown by 30% and you're buying 30% more, you should get some kind of concession on pricing with that. I want to mention 3 quick coaching tips with this, Rich, and if it sparks a 4th or 5th from you, mention it right afterwards. So the first is, I call it a sharp pencil, but a fast pencil. If I have the ability to go back and ask a vendor for pricing discounts, but I'm slow in how I pay them, they're much less likely to go ahead and give me that discount. However, if I'm a good paying customer, not necessarily literally paying the invoice within 2 days of receiving it, but if I don't show up on their aged ARR report as a 60-day or 90-day or 120-day payer, or if I show up as someone who pays my bills within 30 days, it's amazing how much more willing they are to take more of my business versus if I'm both a sharp pencil and a slow pencil, they're less likely to give me discounts. Number 2, I often, when I get a good contract and something I know is likely to go up in cost, right when I sign this contract, I'll try to sign a second contract with an option to renew or option to get the same pricing for next year. They won't always give it to you, but often you can get them to say, hey, we'll get the option to go ahead and do this for the next 12 months or 24 months. The third is, if I'm really negotiating on something, I ask them one question before I ask for the discount. And my favorite question to ask them is something like this, Rich. I might say, for example, let's say you're one of my suppliers and you're selling to me lumber and I'm a construction guy. I might say something like this, Rich, I know you work here with this treated lumber. Let me ask you, I know most people who come to you that are customers stay with you. But when you lose a customer, Rich, and they go somewhere else to buy as a wholesale person, who do you tend to lose that business to? Who's the one that tends to, if you do lose someone, which I know is rare, who is it you lose it to? You make up a name, you say Acme Lumber. Now you're thinking about your competitor. It's a great leading question. Then somewhere 5 minutes later in the conversation, I might say, oh, by the way, Rich, you've been selling us our lumber at X dollars per linear yard or whatever it is that we sell it by. Hey, I need something better than that. What's the best you can do if I give you the same volume or greater next year? But I asked that question. What are some tips you might have that I can use to negotiate effectively better pricing for my suppliers or vendors?
Yeah, so that's a great question. A couple of tips that I have used myself in the past and I encourage my clients to use as well is to strategically look at the broader mix of where they're getting their products from. And sometimes they might want to think about buy or build, right? So sometimes you can create or buy wholesale from another wholesale supplier to create something or to build an internal capacity, but you have to be careful about inventory and things like that. So one is you can go to wholesale suppliers for things. The other thing is I encourage people to look strategically at their supply chain because there are suppliers that have more upside growth potential themselves, which allows them to get cost benefits by buying at volume that they can then hand off some of those discounts to you in the future. So there are not all suppliers are the same. They are smaller, larger, and medium-sized suppliers that can deliver different types of discounts to you as well. So I tend to ask people to look downstream of their supply chain to find out how big their suppliers are, where are they getting their supplies from, and then look at the potential risks that they might have in the supply chain based on things that are going on in a broader context.
I think those are all great ideas. When we think about the value of a dollar saved, here we're talking about we can increase our profitability by managing expenses. And I think it's important, you and I have talked about strategic versus non-strategic expenses before in the past. Could you just define that for our audience, the difference between a strategic expense and a non-strategic expense?
So a non-strategic expense is something that doesn't add value to the business from an equity perspective, something that doesn't add value to the business that extends or can be duplicated moving forward. A strategic expense is something that you spend, like you buy a piece of equipment that can be leveraged over 5 years for X millions of dollars worth of revenue. So a strategic expense is something that you put money into that has a lasting, repeatable revenue impact on the business.
I love it. So strategic expense, the equipment there, now I can produce more efficiently. That either gives me more volume capacity, which makes me more money, or it reduces my labor or other cost, which means it gives me a return on investment versus a non-strategic expense might be something as simple as money that if I didn't spend it, I wouldn't miss it. So marketing tactics that don't work. is an example of a non-strategic expense, or team members of yours that don't really produce a lot of value, or a tool that you pay for that no one actually uses. I see a lot of people saying, oh, this technology, this software platform is going to give me great efficiencies in our business. They buy it. They sign a 1-year contract, 3-year contract, 5-year contract. None of their team uses it.
Right.
They're spending 150 grand a year on something that no one uses. That's a waste of money. That's a non-strategic expense.
One of the filters that I often recommend is do I need it or do I like it? Right. So if you need it, then that's something that you want to
What
look
if I
at.
really, really like it though, Rich?
Really, really like it. If it has like in anywhere in that frame, then that's probably something that you can not spend money on this quarter or not spend money on this year. So I like to get people to think strategically about investing the money that they have to build the business long term, as opposed to just throwing money away at like to have. So I would really like to have that newest iPad, or I would like to have that newest cell phone. Well, you might like to have it, but the business doesn't need to spend money on it because the one you got still works for the next year or two.
And it's amazing when we look at the fractional or the multiple value of the stuff. So I'll give an example. If I have a business that runs and for every $1 that I generate in revenue, it generates 20 cents of profit, pre-tax operating profit, a 20% operating profit margin. If I can, quote unquote, save $100,000 of expenses around this business, that $100,000 of expenses that got saved is the equivalent of me increasing revenue by $500,000, which is hard. It's easier to save 100 grand than to spend to raise revenue by $500,000. Then I'll go the opposite. That's for non-strategic expenses. I should cut those to the bone. For my strategic expenses, if I save for every dollar of strategic expense I save, but I do that by under investing in it, it actually costs me multiples of that. So for example, if I invest in a particular marketing tactic that works, and I say, well, I need to save money, so I'm going to cut across the board 10% everywhere. So I cut 100 grand off my marketing budget just because I want to save money everywhere. That $100,000 of savings, I might be getting a 10 or 20x for every $1 marketing I spend on a tactic that really works. I might make $10 or $20 of revenue. So yes, I've saved $100,000, but it might have cost me $1 million to $2 million of revenue because I underspent in a strategic expense. And I think people get that wrong.
Yeah. And then on top of that, there's this whole thing called opportunity cost, right? So if you're spending 6 months going after securing a new client or a project, and you've ignored all this other part of your business, there's a huge opportunity cost for going down a rabbit hole on one customer, one client, one product to develop that might not generate as much revenue as it. And you look at a lot of people lose sight of the opportunity cost for going after something, after this one thing, and they ignore all the other things that they should be paying attention to. The other thing is that part of this gets, and I don't know if you're thinking about talking about this, but the more complex and sophisticated a business becomes as far as pricing, you have to start rolling in the concept of tax strategy planning, right? Because there's a whole component, a whole other layer of taxation that gets involved in all of that whole thing about how you invest.
We're going to leave the tax for a moment. Here's what I want to do, Rich, because we're coming to the end of our time for this particular episode. In a moment, I want you to share what you think. If you could have a viewer or a listener take one thing away from today that's actionable, what would you want? I'll go first. So for a viewer or for a listener, here's the one takeaway I would want for you. I want you to ask yourself regularly the question, where are we wasting resources that we could reinvest in higher and better uses, right? Whether that be dollars or whether that be talent or whether that be staff attention or hours that way. Where are we spending time, money, or attention that is not giving us great value? And usually at the root of it is either inertia, we've always done it that way, or fear. If I don't do this, I'm afraid it's going to screw it up, right? Don't rock the boat. It's working right now.
Right.
Don't screw it up. Or I'm bored, so I want to change up something that really should have more invested into the tried and true because it has more room for growth. So let's look at it from that frame. Rich, what would your one takeaway be for somebody from this episode of the podcast?
I think the one takeaway would be to understand the complexity of your business model. Is it a complex business model, products and services, customer demographics, or is it a simple, repeatable model? And to analyze those two and look at your return on investment with the money that you're spending to get those customers or to sell those products.
I love it. Well, you've done it again, another half hour with us here on The Business Coach. We welcome you. Say thank you for spending the time that you've done with us. I hope that you take away at least one idea. Don't just listen passively. Take one idea right now while it's fresh, jot it down, and somewhere this quarter in your business, use the idea to make your business more profitable, more valuable, more durable, more scalable. On behalf of The Business Coach, Rich, I want to say thank you for joining me today, and thank you to our viewers.
Thanks very much for having me, David.